Hi there, welcome to Kneppy Invest. Time for another Kneppy's analysis. And in today's Kneppy's analysis, I'm going to look at a company that I haven't really looked at before. And that company is Maas Group. This company listed on the ASX in December 2020. And what they do is quite interesting. In fact, I'll probably classify this company as a diversified construction and real estate company. Now, this company has been around for about 20 years. In fact, it was founded by a 22-year-old, if I remember correctly, in Dubbo. And that 22-year-old has grown this company to be almost $1 billion valued company. And that 22-year-old, whose incidentally name is Wes Maas, so the name of this company gets it from the last name of the founder. He is currently the managing director and CEO of Maas Group. So definitely there is skin in the game because this is a founder-led company. And that is actually one of the most attractive things about Maas Group. Now, in saying all that, I am not a shareholder of this company. I actually have never been a shareholder of this company. And this is just me learning a little bit more about this company that listed on the ASX 2.5 years ago. And there are some things to be impressed with, but there's also some things that I'm a little bit wary when it comes to Maas Group. Maas Group can be separated into two operating segments, industrial and real estate. And industrial can be broken down into three divisions: construction materials, so that includes quarries, concrete, and asphalt; civil construction and hire, and I believe the company was founded with like a tipper truck and something else, which they just hired away. And so the foundation of this company is through civil construction and hire. So that includes equipment hire and that sort of thing, and also manufacturing and equipment sales, and that includes equipment sales. The real estate segment includes residential and commercial. So we're talking about residential and commercial development, home building, build to rent, land lease communities, building materials, leasing, that sort of thing. Now, in this particular slide, they've broken down the EBITDA of all these different segments, or divisions, so we can see the contribution of each and which one is bigger and which one is smaller. By far, the smallest division is manufacturing equipment sales, contributed only 2% of overall EBITDA. And by far the biggest, well, maybe not by far, but the biggest division is civil construction and hire with 33% of overall EBITDA. And if you sort of separate the two segments, 43% of EBITDA is in the real estate segment, and 57% of the EBITDA is industrial operating segment. So this company is becoming more diversified. And that's actually a good thing moving forward for this company. On the 8th of June 2023, the company did release a trading update. It wasn't a profit downgrade or profit upgrade. In fact, it was just a tightening of the EBITDA guidance range. So the original guidance was for EBITDA to be in a range between 150 and 180 million, and they've just tightened that to be in a range between 150 and 165 million. So the lower half of the original range, but that still represents a 20 to 32% growth in EBITDA from financial year 22. So pretty nice growth there. However, the market didn't like it. The share price did pull back a fair bit, even though this wasn't a profit downgrade. But honestly, the market must have been expecting EBITDA to be in the top half of that original guidance range. Before I started researching Maas Group, I did find out that Maas Group was named after the founder of the company. And I just pictured an old dude, something like a 60 to 70-year-old, because I just envisaged this company being around for like maybe 30 or 40 years. But the company was founded by a guy called Wes Maas. And he was 22 when he founded this company about 20 years ago in 2002. So he has grown this company from one bobcat and a tipper truck into almost $1 billion valued company. So he has done very well. So he's a managing director and CEO of this company, and he has really grown this company into what it is today. So I can't really say anything bad about Wes Maas because simply what he's done in a 20-year period. Now, because this company has only been on the ASX for 2.5 years, it's really hard to fully understand the quality of the company. Typically, I'd like to see at least 5 years of history, and ideally at least 10 years of history. So when I look at revenue growth, I tend to look at 10 years, 5 years, 3 years, and trailing 12 months. We only have revenue growth for 1 year. We don't even have revenue growth for 3 years yet. But revenue growth in the past year, trailing 12 months, is 76.5. That's nice growth. Now, EV to EBIT, 12.4. Probably would prefer that to be a little bit lower to gauge the valuation of this company. But based off the growth of the company, you might say or argue that 12.4 is about right for this company. Return on invested capital, fairly low, but again, is that abnormal or is that normal for this type of company? That's something else I'd have to figure out over the next few years. Total return over the past year is only 30.1%, negative 30.1%. So the share price has pulled back a fair bit in the past year. Now, I won't rate this company just yet on quality, simply because it hasn't been around for that long. Now, what they do could be classified as cyclical, particularly when you talk about equipment hire and that sort of thing. So if we do go down that path, I'd probably say more than likely Maas Group would be a lower quality company, but very impressive revenue growth over the past few years. And if they can continue that going, increase the return on invested capital, I could envisage myself thinking this is a lower, high quality company on the ASX. A few other facts in regards to Maas Group. This is at June 21st, 2023. Company founded in 2002. So it's been around for 20 years. And again, it started with that bobcat and one tipper truck. And it's gone from a valuation of a few tens of thousands to a valuation of $903 million. Listed on the ASX December 2020. So it's during that period where a lot of companies listed because the market was in a massive bull run. And the current share price, $2.77, with 327.4 million shares in issue. That's how we get the market cap of 903 million. Now, the shareholder and the major shareholder by far is Wes Maas, the founder of the company. And he owns a majority stake in this company, 53%. And that is actually a really good thing, in my opinion. And there's going to be a lot of investors who agree with me because there is significant skin in the game. And Wes Maas, because this is probably his life's work, his pride and joy, he'd want to grow this company as much as he could. So this is one of the reasons I probably would be interested in taking a position in this company in the future, just because of Wes Maas, the founder of the company, owns a significant portion of the company. Now let's have a look at their financials. This is trailing 12 months. So looking at the first half of financial year 23 and the second half of financial year 22. Revenue up to 671 million. So over a 20-year period, it's gone from nothing to 671 million. That has to be congratulated. Profit of 70.6 million. Now we get to some possible red flags. This company was profitable by 71 million, yet they were operating cash flow negative by 22.5 million and free cash flow negative by 101.6 million. So these are two red flags that I needed to explore a little bit more. So I'll talk about that later in the video. Operating margin at 9.2%. Return on equity, 14.7%. So a little bit higher than the return on invested capital. So a lot of people would prefer, may not prefer, but they would look at return on equity over return on invested capital. But return on invested capital includes debt. And I want to be a little bit more conservative when I use return on invested capital or return on equity. So if you just use return on equity, you might say this is a good quality company because it's 14.7. So let's go exploring why this company was profitable by $70-odd million, yet was free cash flow and operating cash flow negative. And this is from the cash flow statement in the half year's results that were released in February. So straight away, this company was operating cash flow positive before payments for land held for development and resale development costs by 46.5 million. But then there was a payments for land held for development and resale development costs that cost 77.3 million. That's why this company was operating cash flow negative, because of these payments for land. So don't forget, this company is also a real estate company that develops residential and commercial land. So that's why this company was operating cash flow positive. And that sort of did wash away my concerns about why this company was operating cash flow negative. Now, when you look at investing activities, there's a lot of activity going on here. So payments for purchase of businesses, 111.8 million. Payments for investment property, 24.4 million. Capital expenditure, pretty high at 50.1 million. And I expected this company to have a fairly high capital expenditure because they do equipment hire and that sort of thing. And that's why this company, even if you take into account payments for land, that sort of thing, this company is still free cash flow negative. So they actually did use or spend $168.7 million in investing activities. They did a capital raising and raised $108.2 million. That's in the financing activities. Proceeds from borrowings, and if you take away the repayment of borrowings, they added $144 million of debt to their balance sheet. So that's one thing to pay attention also with this company is the debt. So overall, at the end of this half year, they had about $90 million of cash. Yeah, $90 million of cash, but if you look at their borrowings in the liability section of the balance sheet, $52.8 million of current liabilities and also $433.6 million in non-current liabilities. Now, they've grouped together the borrowings and lease liabilities. I probably would prefer them to separate those two things because, in my opinion, lease liabilities more belongs in the cash flow because it's a operating cash flow sort of thing. That's just the way I look at it. I'm a little bit different. They did make changes a few years ago in regards to how accountants deal with lease liabilities. So the other things I look at this is inventories, $107.6 million of inventories in the current assets, $130.8 million of inventories in the non-current assets. We also have to take into account investment properties. So $164.5 million investment properties and property, plant, and equipment, $480.8 million. And that did rise significantly from 1 year ago. In fact, it grew by 50%. So it seems like they did spend a lot of money increasing their property, plant, and equipment over the past year. And overall, total assets, 1.3 million. Total liabilities, 677 million, which means the net assets are around about $590 million. And that has grown significantly from last year, 455.9 million. So one of the reasons why return on invested capital was significantly lower than return on equity is because of the borrowing. So we do see this company have a lot of borrowings, and that is probably the main concern I have in regards to Maas Group. But in saying all that, this company is growing really nicely. Now, we don't have much history here, and this EBITDA history comes straight from the company itself. Over the past, this is a 4-year history with a forecast for financial year 23. And EBITDA has grown from $50.1 million in financial year 2019 to be between 150 and 165 million in the current year. So it's tripled over the past 5 years, compound annual growth rate of 34% per year. And if they can continue to grow like this, I think this company is looking more interesting. But that is a question we have to ask ourselves. Can the company continue to grow at these really impressive rates? Another exciting thing about Maas Group is they are a dividend-paying company. They're profitable, that sort of thing. Now, the dividend yield only 1.8%. And probably the other negative, maybe a slight negative, we haven't seen significant growth in dividends, but that's okay. I don't mind these sort of companies not giving their shareholders a lot back in dividends. But if you do look at the interim dividend for this year, it was higher than last year. So it's gone from 2 cents to 3 cents. So that's a 50% increase in interim dividends. And whether we see another increase in final dividends remains to be seen. And if we do, and the share price starts to tumble a little bit, we might see a bigger dividend yield than 1.8%. Now to some valuation metrics for Maas Group. And this is where it does become a little bit interesting. The current PE ratio of this company is around about 12.7. That is attractive. So remember the EV to EBIT was around about 12. I probably would prefer that a little bit lower than that, less than 10, but still, that's not expensive. The PB ratio, 1.65. Now, that's okay. If you don't know what price to book, it's just looking at equity. So you divide the valuation of the company, the markup, by the equity, the total equity. You get 1.65. Price operating cash flow is not applicable because they were operating cash flow negative. My favorite metric, in fact, is EV to free cash flow. And again, that's not applicable because the company is not free cash flow positive. Now, I did do a reverse DCF, and I do these for all Kneppy's analysis companies using earnings per share, not the operating cash flow or free cash flow, because again, those are negative. And based off the earnings per share, to justify the current valuation, Mars Group would have to grow at 5.2% per year. And I definitely think the company can achieve that sort of growth rate in the earnings per share. However, I am concerned about the possible cyclicality of this company and how the cycle, the business cycle, mining cycle, could affect this company in the next 5 to 10 years. Now let's have a look at some charts. And the first chart here is a weekly chart going back to when they listed on the ASX. And when they listed on the ASX, the share price was around about $2.40, $2.50. And we saw the share price of this company go on a really nice run. In fact, the share price went from about that $2.50 to a high of over $6.20 in June 2021. Beautiful looking chart. But that high was 2 years ago. And ever since that high, the share price has been dropping. Now, there was a really strong support level for the company at around about $4.20. It tested that level 1, 2, 3, almost 4 times before it finally fell through that level in June of last year. And then we saw the share price drop and then test that level again. You can just see it. Just the share price graze that level in, we'll say, July, August of last year. And then we saw the share price absolutely collapse towards the end of 2022. Share price went from about $4.20 all the way down to a low of $2.20. So the share price almost halved in about a 3 to 5 month period. But the share price does look like it's trying to turn around. Share price has seen one higher high and one possible higher low. So if you just look at the weekly chart, you could argue the share price is trying to move back into an uptrend. And you can almost see that uptrend developing when we look at the daily chart. And we're going back to September of last year. The share price did reach that low of about $2.20 in the middle of November. And the share price then started to turn up. We saw a little bit of weakness in February, and that was around the time they released their results. But that weakness didn't last very long, and the share price went back into an uptrend. And then when the company released the trading update, we saw the share price pull back a fair bit. But the share price is really struggling to get below $2.70. So possibly the share price has reached its low. And if it has reached its low, that means the current low is higher than the lows we saw back in February. And that would be confirmation, maybe not overall confirmation, but that would be a good sign the share price of this company is trying to move into a well-defined uptrend. If you'd like me to feature a company in this Kneppy analysis video series, you can leave a suggestion in the comment section of this video and I'll see what I'm able to do. In fact, the next 5 companies I'll be featuring in this video series include a few suggestions. I believe AGL was a suggestion. Lycopodium, the next company I'll be doing, I believe that was a suggestion. And also Universal Store was a suggestion. The only 2 non-suggestions that I just decided to do, Technology One, because it might be one of the highest quality companies on the ASX, and also WH Soul Pattinson, a company I have never owned in the past, but I do follow quite closely. So again, if you have any suggestions of companies you'd like me to feature in this series, just leave them in the comment section of this video. And that's all I have for this video looking at Mars Group. If you have any questions, any thoughts about this company, maybe you know way more about this company than I do. I'd love to hear your thoughts, your opinions on Mars Group. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.